Wall Street just delivered its best Thanksgiving week in 16 years. The S&P 500 surged 3.7%. Small caps exploded 5.6%. And the Fed is about to pivot. Here's what it means for your money. I'm Burke, a financial advisor and long-term investor. I started as a hedge fund trader and research associate at a $250 million fund. I spent the next 20 years managing portfolios and teaching value creation through EVA and value-based management. Now I help people become shareholders through disciplined investing and direct ownership of the world's best businesses. Because if wealth is your goal, you can't let a 3 to 5% swing in a week knock you off course. The math of compounding only works if you stay invested. Let's get into it. The S&P 500 surged 3.7% during Thanksgiving week. That's the strongest holiday performance in 16 years. Let's start with the numbers that matter. Small caps stole the show. The Russell 2000 surged 5.6% as rate cut expectations came roaring back. Fed futures are now pricing an 85% probability of a December rate cut. And Broadcom, one of our holdings, jumped 18.5% on AI partnerships with OpenAI and Google. These aren't random moves. There's a story here. Small caps stole the show this week. Here's why that matters. When the Federal Reserve pivots toward easier policy, smaller companies benefit disproportionately. Why? 3 reasons. First, floating rate debt. Many small caps have variable rate loans. Lower rates mean lower interest expenses instantly. Second, shorter financing cycles. They refinance more often, so they feel rate relief faster. Third, cheaper refinancing ahead means they can invest in growth instead of servicing debt. The Russell 2000's 5.6% weekly surge wasn't random. It was the market pricing in a friendlier Fed. Let's look at how the major indexes performed through Friday's close. The S&P 500, that's your 500 largest U.S. companies, finished up 3.7% for the week and 17.6% year-to-date. The NASDAQ 100 rallied 5% for the week but remains down slightly for November after the mid-month AI shakeout. But look at the Russell 2000, up 5.6% for the week, up 13.5% year-to-date. Here's what matters. Broad participation strengthens the foundation for future gains. When leadership extends beyond just the mega caps, that's a healthier market. Now let's break down sector performance. Who led and why it matters. Technology gained 4.8%, powered by a rebound in AI infrastructure names like Alphabet and Broadcom. Consumer discretionary rallied 4.9% as holiday shopping data came in stronger than feared. But the real standout? Healthcare, up 9.5% for November. This sector has become a destination for investors seeking growth without stratospheric AI valuations. Merck's cancer franchise, Eli Lilly's obesity drugs. These are real cash flows compounding year after year. Now let's talk about this week's biggest winners. Kohl shocked everyone by surging 40%. The department store posted a surprise profit when analysts expected a loss. Combined with 26% short interest, you got a classic short squeeze. Broadcom, one of our holdings, jumped 18.5%. The AI narrative shifted back to recognizing that the build-out requires more than just GPUs. Broadcom designs the custom accelerators that OpenAI and Google depend on. Reddit pushed into elite territory with a relative strength rating above 90. Triple-digit earnings growth plus AI data licensing deals. And SoFi rallied as institutions continued accumulating shares. They raised 2025 guidance across revenue, EBITDA, and EPS. Risk appetite is alive and well, but not everyone won this week. And the losers teach us something important. Tilray announced a 1-for-10 reverse stock split, often a red flag. Combined with legislation pressuring hemp products, investors headed for the exits. Zscaler actually reported strong results, but guidance raised questions about near-term profitability. When you've rallied that much, anything short of perfection triggers profit-taking. Deere beat on Q4, but guided below expectations for fiscal 2026. The agricultural downturn hasn't bottomed yet. Supermicro missed earnings and guided cautiously. Even AI hardware has cycles. The message is consistent. Markets remain ruthless toward high expectation stories that even slightly disappoint. Now let's talk about the Fed. This is the story underneath all the other stories. JP Morgan just shifted its base case to a 25 basis point cut in December. They had been calling for January. That's a significant change. Fed funds futures now price roughly 85% probability of a December cut. The Beige Book described economic activity as largely unchanged, with a slight decline in employment and softer consumer spending. That gives policymakers cover to proceed. The policy direction is clear. The Fed has shifted from fighting inflation at all costs to avoiding an economic break. For long-term owners, this is constructive. Policy is no longer fighting your equity ownership as directly as it did in 2022 and 2023. Here's why the Fed has room to cut. The labor market shows surprising resilience without overheating. Initial jobless claims fell to 216,000, the lowest level since April. Economists expected claims to rise. Instead, they dropped. That's meaningful. Continuing claims sit around 1.96 million. That's a low-hire, low-fire equilibrium. Companies aren't aggressively adding headcount, but they're not letting workers go either. CPI is running at 3% year-over-year. Core inflation, also around 3%. The Fed's preferred PCE measure is near 2.1% quarterly. This mix, slow but not broken growth with easing inflation, is precisely the environment that supports equities. Now to the core of this update. How your value-aligned portfolio performed this week. Broadcom led the way, up 18.5% for the week, closing at $402.96. That's 75.1% year-to-date. The 10-gigawatt partnership with OpenAI positions Broadcom as a foundational layer of the AI economy for years to come. Tesla rallied 10% to close at $430.17. No single blockbuster announcement, just the market digesting robotaxis, humanoid robotics, and energy storage optionality. ASML gained 9.7%. They hold a monopolistic position in EUV lithography. If you want advanced chips, you need ASML machines. Period. Merck delivered 7.2% for the week and 21.9% for November. Expanding Keytruda indications keep the cancer franchise growing. And Alphabet gained 6.9% to close at $320.18. Year-to-date gains now 69.7%. The market rotated toward AI platform winners. These aren't trades. These are ownership stakes in businesses building the future. Let me leave you with 3 big takeaways from this week. First, this was a broad-based rebound. Large caps, small caps, tech, cyclicals, all participated. That's the strongest Thanksgiving week since 2008. Second, AI is maturing. This is no longer a one-way trade. It's becoming a stock picker's market. Broadcom, Alphabet, and ASML got rewarded. NVIDIA and Supermicro struggled. Third, the macro has shifted. We've moved from how high do rates go to how gentle will the landing be. That's a fundamentally different question. Policy is no longer fighting equity ownership. It's starting to support it. So what do you do with all of this? Stay the course. Use weeks like this to review your plan, not to chase what just went up. Review the businesses you own. Ensure your allocation matches your goals and risk tolerance. Build for the next decade, not the next week. You're not trying to beat traders. You're trying to own the future cash flows of great companies long enough for compounding to do the heavy lifting. This isn't just paperwork. This is your legacy. That's your market update for the week. If you found this helpful, here's what I want you to do. Suppose you're serious about compounding your retirement, finding companies that double their share price every 3 to 5 years, and learning why owning great businesses with aligned management teams lowers your monitoring costs. In that case, there's a link in the description for a free consultation. We'll map out where you are, where you want to be, and see if working together makes sense. If you want more market insights like this, you're going to love this video right here, where I break down why thinking like an owner, not a trader, is the single most important shift you can make for your wealth. Click it now. I'll see you there.